Good afternoon, ladies and gentlemen. My name is Fred Brown. I'm a partner at Oliver Wyman, and I'm the Chief Operating Officer of our 3D Carbon Accounting team. I've been your journeying companion today. This is the last session. If you've been here for all of them, well done. A drink awaits, I hope. Unusually, we're going to do, there's a few announcements we normally make at the end of this session, but I think you're going to want to get away, and so we're going to do them now. The first is really to say a huge thank you to all our panelists and moderators today. I think we've had, look at, I mean, this room is full and has been all day, so I think it's been a terrific success. Alec Walton is the CFO of Innovation Zero. I think we give him a huge round of applause for putting this show on. Alec, I mean, have a look, my friends, have a look. You created this. It's extraordinary. Thank you. We're in your debt. Irina, the wonderful Irina, who's at the back somewhere, there you go, give her a round of applause as well. It's not been an easy job today. It's been standing room only all day. And the AV team at the back who've battled through some challenges. Actually, come and give them a round of applause as well, because that's not been easy, bless them. They've had a tough time. Listen, dates for your diaries. This event here in London back next year, 30th of April, I think, Alec. Am I right in saying? 30th of April and the 1st of May next year, we'll see you here. And Riyadh, dates TBC, but February most likely. It's my birthday in February, Alec, just saying.
Well, you can come along.
I'm going to hand over now to Alec. I think he's going to say a few words. But so here's Alec Walton, who's the CFO of Innovation Zero, and enjoy the final panel.
Thank you. First of all, thank you, everybody. This event has been an amazing, amazing event. And fundamentally, that's down to the participants. So I'm not going to ask you to applaud yourself, but I will. Thank you. Thank you, everybody, for turning up. Thank you for taking part. Thank you for your questions to the panelists. And the second big thing, without content, there's no audience. And we have had fantastic speakers, and we've also had fantastic chairs. And I wanted to say a big thank you just now to Fred for looking after us all day. So thank you, Fred. And from there, I will simply hand over to the panel and let them entertain you, because I won't. Thank you.
Thank you so much, Alec. And good afternoon, everyone, and good to see you all, actually, and welcome to the final panel of the day in the finance zone. So I'm Kalyani. I'm going to be a moderator for this panel, and the topic is quite exciting. It's on carbon offsetting and the strategies, how do you set up your carbon offsetting strategies. So I'm an independent ESG and carbon consultant working on a variety of projects right now, and we have a great panel today. Professor Raul, Jen, Muriel, and Michelle, can you please kindly introduce yourself to the audience? Thank you. Yeah.
Thank you very much, Ariane. Raul Rosales, I work as Senior Fellow at the Center for Climate Finance and Investment at Imperial College Business School. I am mostly responsible for the Singapore Green Finance Center, a center of excellence for research and education in Singapore, with the Monetary Authority of Singapore, 7 banks, and 2 big asset managers. We basically bring together the financial industry and the academia with the government, coming out solutions to unlock capital markets in the space of climate change.
Great. I'm Jen Sulo, managing partner at Earth Finance Asset Management. My prior role was, I've been in this role for 2 months, so brand new, excited to see all of you. My prior role was Global Head of Sustainable Investing at Goldman Sachs. I'm the only one who's been given mic privileges, so you're going to listen to me for 45 minutes.
Hi, everyone. I'm Michelle. I'm CEO and co-founder of Supercritical. We are one of the world's largest carbon removal marketplaces. 2 of the top 20 buyers, 29% corporate customers. We sell things like direct air capture, biochar, enhanced weathering. These are the only credits that help you get to net zero.
Is this working?
Oh.
Yeah, it's working. I also was given privilege. Hello, everyone. Thanks for coming here. My name is Miriam Meneses. I am based in London. I am a senior consultant and carbon market specialist for EcoAct, where I also lead the carbon credit advisory, and we help companies set and develop carbon offsetting strategies, but also advise them on how to develop projects, and we walk them through the process for developing a carbon project.
Thanks, Muriel. So, yes, I need can you all hear me?
There you go.
Okay, so carbon offsetting, carbon markets and carbon offsetting strategies. As we all know, and we are witnessing currently the voluntary carbon offsetting has growing rapidly, and many organizations have been starting to begin to use of setting to reduce the carbon emissions, the offsetting strategies. However, this market being unregulated and offset providers offering plethora of carbon neutral services, it makes it very challenging to understand what is a very good quality offsetting is, or what is offset, or what is offsetting strategies. And not to mention the recent trust deficit and scandals that have upset the markets. And it is very evident that market requires a robust due diligence framework. And underlying challenges such as transparency and verification remains the key area of focus, or maybe will continue to remain the key areas of focus with so many verification bodies coming out every day into the market, who are offering their auditing services. So what is a good offsetting strategy for a long-lasting success? And what are the best key practices? To start off with, Professor Raul, with you, so there seems to be like, the greenwashing, which is also happening rapidly in the carbon markets. So how do you go beyond to the greenwashing risks during the carbon offsetting strategy, and how do you actually make sure that, it's validated? How do you start? Which technologies are in place? Yeah.
Thank you very much. Well, I use this. Well, I think, first of all, talking about voluntary carbon markets or carbon finance markets in this context of these definitions of greenwashing, I think we need to be, or to speak in a very positive and constructive way, because business and markets are based in trust, and if there is no trust, there is no business. So that's the first point. Talking about technologies, for instance, the blockchain technologies, there is no doubt about the added value of a blockchain in order to provide the transparency, the trust, the integrity that we need in carbon markets. There is no doubt about that. However, I want to say the following. One of my colleagues, Ian Stafel, conducted a survey last year, by the end of July, with other scientific advisors, and they conducted a very good survey on scientific research with 39 firms working right now with blockchain technologies in the context of carbon finance markets. 39 firms. They developed and applied technology readiness level, TRLs, scale, in order to make the assessment of the validity of these kind of blockchain technologies applied in their businesses, with different uses, with ETS, voluntary carbon markets, also with Corsia. And one of the conclusions, well, the main conclusion is that, surprisingly, is that most of these technologies are below number 3, okay, below proof of concept. So, and there was just only one, number 9. Yeah, means, I think you hope, you understand about that. Just only one. So what I mean as a conclusion about this, because this is quite complex, is these blockchain technologies, regardless, there is no doubt about the potential, they are not mature, not yet. Okay, there are plenty of firms using them, working with them, but we need maturity in these technologies. And blockchain technologies should be seen as a foundational technology upon which to build up the kind of market efficiency and market integrity we need for voluntary carbon markets.
Jen, do you want to talk through how do you actually involve different stakeholders and along with trying to identify the greenwashing in the offsetting strategy? Thank you.
Sure. So maybe before we jump into that, let's just baseline for a minute. So what is net zero within an investment portfolio, and what is it not? So net zero is a commitment to align with net zero and decarbonize your portfolio over time. It's not a mandate to divest. It's not a mandate to meet net zero tomorrow. It's a plan to measure and engage and get there through time, through interim targets. Now, getting there involves 3 levers generally. The first one is to decarbonize, not divest, decarbonize thoughtfully, invest in climate solutions, and create an engagement strategy. I think generally carbon offsetting has been only been used really for the hardest to abate emissions and for residual emissions. Now, there's a growing cohort of investors, myself included, who think we can actually mitigate carbon emissions and remove them in parallel. So that being said, there's still a priority on the engagement, evolving, helping companies to evolve and create transition plans. But there's this fourth lever, which can accelerate climate transition, which is the carbon removal, carbon offset story. So I think selecting best-in-class providers is the key kind of challenge here, right? Because the markets are fraught with greenwashing. And so it's not that there's a bunch of bad actors out there, it's that asset managers are trying to evolve with global regulation that's moving rapidly. The definition of sustainability is opaque and changes from region to region. And stakeholders are committing to net zero and they don't know what that means. So they're in turn saying, I committed, I'm excited. What do I do with my investments? And so I think it's so important, and we're going to talk about this in the subsequent sections, but to diligence not only the carbon credit, but the carbon project. And we're going to talk about exactly what that means and what questions we can ask to facilitate that.
Sure. Thank you so much. Michelle, from your point of view, how are you eradicating the greenwashing in your projects? Yeah.
There you go.
Yeah, thank you. I love what you just said about in parallel decarbonizing and scaling removals, because we absolutely need to do both at the same time. I know in the mitigation hierarchy, you should reduce first and then remove your residual emissions. But the fact is if we don't have buyers of these removal technologies, we won't get to the 10 billion ton scale we need annually by 2050. And I actually think that, one of the philosophical choices we made when we started Supercritical was to only sell removal credits. And the greenwashing around removal credits is a lot less fraught because it's not based on this hypothetical counterfactual baseline scenario to prove additionality. So the typical emissions avoidance or reduction credit need to predict what might happen in the future, how quickly would that tree get cut down, would this coal plant transition to renewable. You're guessing the future and you're going to be wrong, whereas with removals, it's a lot more straightforward to document, monitor, and measure a ton of carbon being removed and how long it's sequestered for. So that's the main thing, and we've found that we think that conventional emissions avoidance offsets are a thing of the past. In a net zero future, the only way to hit that net zero is to remove the permanent carbon removal, and we just kind of want to be in that future now rather than transition and take a long time to deal with the past. So that's our main response. And we've seen a lot of corporates confused, scared. They've been buying conventional offsets. They've bought projects that have been, headlines of the Guardians, and they are moving to removals because they can see that it's a lot easier to stand behind. And we have an in-house team that vets the credits. We have scientists that stay on top of the literature and the innovation happening, and we just want to make sure that we are only selling high-quality carbon removal.
So Miriam, how is EcoAct reacting to this one? Yeah.
So we work with a different and a wide variety of sectors, and all those companies have different levels of ambition, have set different targets, have also different interests, and also have different local contexts that they need to respond to or comply with. So when we advise companies in setting up their carbon offsetting strategies, the first question that we ask is, what do you know about your company? Do you know your carbon footprint? Do you know the story of your company? What are your hotspots? What are you doing to reduce your emissions? Have you quantified that? And once we have done that, then we ask them, what's your ambition? What's your target? A lot of companies can set targets, but it's really hard to achieve them and get to that level of ambition that is necessary to achieve 1.5 degrees. So once we have gone through those first steps, then for us it's important to understand if carbon offsetting would be an option for them or not. It could be the case that it might not be the most cost-effective solution for them, and mitigating within their value chain is the option. So in order for us to get to that stage, we also need to ask questions. Do they understand the market? What are their fears? Have they engaged with stakeholders internally, externally? What are the compliance obligations that they have? So we need to take a holistic approach when advising companies in developing these carbon offsetting strategies, because as you said, it's not a silver bullet. Is one small piece of the puzzle that they need to take into account. And when they present this to the board and say, this is how much it's going to cost us to achieve net zero, or this is how much it's going to cost us the inaction, then there is where the board starts asking questions, and you start speaking their language, explaining to them, this strategy is more cost effective. This is what is going to help us achieve our target. This project, for example, if they opt to buy carbon credits, maybe if they opt to invest in projects that are more attractive. And again, it depends on the level of ambition, the targets that they have set, and it could be both. It could be avoided emissions, or it could be investing in renewables. It depends on the preferences of the company.
I totally agree. I mean, it's all to do with the involving stakeholders. I mean, you can't achieve this objective alone just by just being your own, the developer. So I totally agree. So from my own experience, I'm working with the project developers right now. I see that while defining an efficient, robust carbon offsetting strategy, there are so many challenges, especially identifying parameters. So how do you identify the boundaries? How do you want to say, this is how we want to estimate, your emissions, and there is a lack of baseline data that makes it more complex and super challenging. And so my next question is going to be, while defining an efficient offsetting strategy, I know we can't touch every single parameter, but what are the main maximum or minimum parameters we should be looking for, and mainly challenges? Challenges especially I'm facing is, limitations, lack of technology in remote areas. It's super hard to track and trace, or maybe there is a technology, but you don't know how to put that into very good use. It's both the ends I'm seeing right now. And how do you actually improve this? And how do you actually set parameters? I mean, we can touch briefly on that. And Professor Raul, from your perspective, can you actually talk something from the BCM market? How are they scaling up, and how do you set up the parameters? Thank you.
Thank you, Kalyani. Well, more than the parameters that we need, I think talking about the carbon finance market, the voluntary carbon markets, I would like to address this, what we really need. Well, first of all, we need to look at this with a capital markets approach. And in this context, I would like to talk about a market infrastructure. We need market infrastructure to scale up, to build up the carbon markets. And because we need this kind of regulated market infrastructure. These are unregulated markets, but the market infrastructure can be regulated. And this is the case, for instance, of the first initiative in the world with the London Stock Exchange Group, with the Voluntary Carbon Market Initiative launched in November, December last year. This is a very good example. Other examples of stock exchanges with similar initiatives in Asia in the past few months, in Indonesia, in Japan, also in Hong Kong, stock exchanges. We need this kind of capital market infrastructure which is regulated to provide the transparency, the liquidity, the access to investors and to corporates, fully compliance with all the things where you are listing an investment fund, for instance, in a stock exchange. And it works, because with that kind of regulated market infrastructure, you tick all the boxes that you need to work with efficiency and integrity in the market. There are other initiatives as well, for instance, with this kind of group of banks with Carbon Place, that this is a market infrastructure for clearing and settlement, still working on that. I think they will be up and running by the end of the year. But this is what we need in order to cover all these kind of ingredients that I was asking for.
Jen, how are you going to see from the investment manager's perspective for this?
Sure. So when I think about setting up a credible carbon offset strategy, there's generally 3 ways to do it today. The first way is to engage with the marketplace, a broker, an exchange, and go buy credits in bulk. Now, we're all reading the same headlines. There's a clear lack of transparency there. The second way to do it is to engage directly with carbon project developers and kind of try to create your own wholesale strategy, which is what some of the very large corporate players are able to do because they have the staff to be able to facilitate something like that. The problem with that is it takes time, right? You have to find the credible project developers who have the technical expertise you need. And there's also a mismatch of supply and demand there. The third way is to create a carbon derivatives overlay strategy, which basically takes positions on the future. I would be most reticent to do that, given there has not been guidance from IIGCC with respect to how derivatives fit into the net zero pathway. And so I think that's probably the riskiest way to do that, because if guidance does come out and you're not aligned with it, it's a suboptimal result. I think the right questions to ask lie at two different levels. The first level is the carbon project development, and the second level is the carbon credit. So at the development level, one of the things that we're working on is to create a framework of due diligence very similar to what you do in a traditional investment. So a traditional investment, we're diligencing the investment firm and the investment strategy. At the carbon project development level, there's 5 tiers we're looking at. Sovereign level, what's the geopolitical risk? What's the transition risk of the project? Where is it located? Second level, how about the firm that's developing the project? What's their commitment to communities? What's the externality exposure? What's their ethos? What's their philosophy? What are they about? Is there reputational risk there? Are they doing the right thing? Are they thinking about things the way that aligns with your vision? Third piece, people. Are the people who are actually generating these carbon credits have the right expertise to do it? Do they understand what they're talking about?
Technical knowledge.
Exactly.
Yeah.
There's a lot of players in this market right now, and it's really confusing. Fourth level, process. What's the process for generating these credits, which will vary depending on the type of credit? And fifth level, on the project level, is impact and thinking through how does this align with SDGs? What's the ESG scorecard on this? Thinking through all the reporting implications. So that's just the project level, right? Now, if we think about the credit level, we generally think about it in 3 different dimensions. Credit level, we think about the measurement of error, really, and what's the range there, because there is a range and an understanding, just like with tracking error and volatility of a traditional investment. How can we look at the range of expected error with respect to a carbon credit? And I think that's what's probably missing the most in markets today. The second piece is permanence and quality. So are we looking at something that's less than 30 years, 30 to 70 years, 70 plus years? Like, we need to understand the permanence. Is this mineralization? Is this kind of liquefied and buried? Is this, what is this credit about? And the third level is location. So thinking about the geology, the ecology, and the economics of each credit. And so I think all of these levels are critical in trying to flush out this really the credibility of an offset strategy.
And then to add to your technical qualities you mentioned, I think I see this often with a lot of developers. They estimate the credits. That estimation error can go up or down, or it just never happens. So that estimation, the baseline data is critical. I've just seen, and then I think that could be added to the technical qualities as well.
Agree.
Sure. Thank you so much, Jen. So, Michelle, from your point of view. I should go.
Yeah, this is just all explaining how broken the voluntary carbon markets is. The fact that a buyer shouldn't have to do all this work to know they're buying something that's good. The person who's selling it, and there should just be more infrastructure in place. And my biggest frustration, I come from the tech world. I'm an exited tech founder, but coming in as an outsider, looking at the voluntary carbon markets and just being shocked at what's being sold, and there's just no recourse, and people are buying these credits. Every single buyer I spoke to when I was researching starting the company had said, when my broker gave me the credits, I was really shocked at how cheap it was, so I just bought twice as many to cover my ass, because hopefully that meant that I was doing the right thing. Because if you buy twice as much crap, it's twice as much crap, right? And I would love for there to be regulation and market infrastructure, but we cannot wait 5 years for that to develop. We just have to act now. We have to scale these technologies now. And so we're trying to plug that gap with our marketplace, but I would love it if we could hand over certification and work with a third party we can trust. It just doesn't exist yet. And on your kind of criteria, I think permanence absolutely is the main one that I think the market doesn't really talk about. And once that ton of carbon's emitted in the atmosphere, it stays there forever. So you need to know that it's being stored or avoided for the same amount of time.
Sounds like the permanence is one of the main parameters. That's what I'm identifying from 3 of you. So Muriel, what could be your takeaway on this? Thanks.
I think Jen already covered most of what I wanted to say. So what we see as a main challenge for corporates that want to engage in the voluntary carbon market or overall in carbon offsetting. So companies are generally really good at understanding where their compliance obligations are. They already know they are regulated. For example, companies that are subject to an ETS, to a carbon tax, they know what they have to do, and they have strategies in place for that. But those same companies want to go above and beyond, and there is where they want to start engaging in this, setting these voluntary targets, engaging in the voluntary carbon market. And because there is a lot of noise, and it's, let's face it, it is complicated, and there are a lot of actors, there are a lot of standards, it's hard to navigate. So they are missing, they know the how, they don't know what to do and when to do it. So that is the main challenge for companies. When is the right time is, it's challenging also for them to understand. Because when they want to engage in investing in carbon projects, or even buying carbon credits from this pod, they need to understand what their preferences are, what their timelines are for what is that they want to buy carbon credits. I think we left behind that area in which companies just wanted to buy carbon credits just because.
Right? They should have their own due diligence.
They need to conduct that due diligence, but that due diligence, yes, are questions that you need to follow, all those questions that Jen mentioned, but those questions would also respond to what the company wants. What are their preferences? Where are the projects in which they would like to invest? Where they like to invest in projects that are closer to their headquarters. They want to have an impact in the communities that are close to their suppliers. What is that they want to do? What are the co-benefits that they want to prioritize? And with that, just rank the projects, and with that, develop that carbon offsetting strategy. Now, when they do that, and when they select those projects, they also need to understand how long is that going to take for those credits to be issued. Is not the same for avoidance projects. For example, cook stoves, renewable energy projects, forestry projects take longer. Then we have removal technologies coming into play, which we also need to wait for methodologies to be out there to be able to certify those credits and then coming live into the market. All those factors companies need to take into account, and it is challenging. But companies are getting there, and I think what also Michelle and Professor Raul said is the market infrastructure that needs to improve and give clarity to corporates on how to do that.
Can I just jump in? Well, I guess for the corporates we work with, all those things, co-benefits, location, all that stuff matters. But at the end of the day, if you've set a net zero target, 2030, 2050, whenever, and you know at that date you need to remove whatever your residual emissions are, you need a strategy to make sure that you can access those credits at that point, start small, ratchet up over time, and develop the relationships with the supplier so that at 2020, 2030, 2050, you've got 1 million credits available to you. And the fact is, if we don't have people doing that today, that supply won't be there. And that's kind of how we advise our clients to think about the offsetting strategy. It's following the Oxford offsetting principles, right? Like grow the share of permanence over time.
Thank you. So,
I would like to say something as well about, I fully agree, we need action right now. For instance, we cannot wait, for instance, for the full operationalization of the Article 6 and all the politics behind that. It will take years, and we need to act now. But at the same time, my advice for the industry and for the market is don't rush deploying voluntary carbon market strategy. Let's go to do this well, because we need to build up this with market efficiency and integrity. We cannot have mistakes. I would like to highlight something in the process of this kind of voluntary carbon markets. The due diligence process is critical, as all of us know. And I think we really think we need to do this project by projects, the due diligence. And finally, I would like to say a couple of things in terms of the policy measures, pricing. Talking about voluntary carbon markets, capital markets, and investors, pricing is critical as well, because when you talk with investors in the necessary environment, always the whole day listening, we need to move billions, trillions, whatever. When you're talking with the financial industry and with institutional investors, it's all about risk and returns. Don't get distracted about anything else. It's risk and returns. That's it. Because this is what they are looking for. And we can do that. We can do that in the space of voluntary carbon markets and mitigate the climate change and this kind of climate emission. We can do that, but we have to do this well. In this context, the pricing of carbon is one of the key elements for that pricing. And this is pricing in carbon offsets. This is a policy measure. There are 3 or 4 angles to tackle that. I would like to say something, one which is carbon taxes.
we need a sound carbon tax framework by countries in order to give a price signal to the market and also to help in the decarbonization of the economy. Okay, maybe it is not very nice to hear that, because when we talk about taxes, we know the implications for all of us as well as individuals. But if in the context of the net zero, we want to speed up the process of decarbonization, and in this kind of journey towards net zero, we need carbon taxes to help the heavy industry emitters like steel and cement to go through that way. And also these kind of carbon taxes will help to give this kind of price signal to the market. For instance, there are, I cannot mention some of these kind of industry investors from Indonesia. A couple of years ago, they raised a huge carbon credit fund to help the steel industry to decarbonize. What's going on? Look at the pricing of carbon credits in Indonesia, almost nothing. So it doesn't work, the business model. Either there is a very good price signal and a very high price in the high quality carbon credits, or investors will not be able, industry investors, to raise carbon credit funds to decarbonize the heavy industry emitters. This is all about the business model.
That was a great academic explanation. Thank you, Raul. So Muriel, you mentioned a very good point on cook stoves and forestry. That's my next question, actually. So I've identified there are like several classifications when it comes to carbon credits, like forestation, and nature-based solutions, tech-based, household, chemical, and industrial, the waste, transport, and so on. And I see that the NBS, the nature-based solution, which is a big thing, is a forestry. Current market value is $8 trillion. So, which is like, no doubt, I mean, there's a lot of developers who wants to go into NBS, and, it's picking up a lot of momentum at the moment. And I'm seeing Red Plus is going to be leading that, the Red Plus forestry projects. So while setting up an offsetting strategy, obviously, there is a short, medium, and long term, and cooking stoves might be like, immediate returns compared to the forestry. I mean, can you all just briefly touch base? I mean, I'm not looking for like a deeper explanations, but differentiating, I mean, minimum and maximum with the NBS and, the other projects. How do you offset a strategy? I mean, what you should be looking, the key points, really, just briefly. Thank you. Yeah. Jen, do you want to start?
Sure. So I'm happy to start. So
Fine, go ahead.
did you want to start? Do you want me to start? You asked the question to her, and then you
Yeah,
so I wasn't sure.
I'll take it.
Okay, you take it, and I'll chime in at the end.
Yes. So I think it's up to the company what they want to do. It is not a matter of, it is better nature-based solutions or technology-based solutions. I think it's a question of both are important, both are necessary, and both are at a different stage of development. And companies need to acknowledge that. We all know that. We are going to get there eventually. Yes, technology will move on. Hopefully we will get to a point in which the technology readiness levels are at the maximum at 9 and it's not 1. That's my wish, but again, it's a wish right now. What companies want to or have to do, it depends on what they want. Again, we need both solutions right now. We also need to consider the availability of those at the moment, and companies need to find that sweet spot between short-term and long-term ambition as well. And maybe in the short term, and if we recall what the Oxford Principles for Net Zero said, is like for the upcoming decades, we have avoidance solutions transitioning into more permanent solutions. So nature-based, technology-based solutions towards 2040, 2050, and that is what companies need to take into account in their offsetting strategies. Now, whatever they decide to do, nature-based, technology-based, avoidance, removals, what they need to be aware of is the disclosure requirements that they would need to comply with. So the voluntary schemes that we are used to, science-based targets, CDP, will eventually no longer be voluntary. We have already seen CDP, for example, asking and putting a lot of scrutiny as well on what companies are doing in terms of carbon pricing. Are they complying with their compliance obligations, ETS, carbon tax? How are they doing it? And they this year incorporated a new question, which is about credits. What credits are companies buying? Which type of projects? How did you measure additionality, leakage, the volume? And companies will only be able to respond to those questions if they have a robust carbon offsetting strategy, if their internal stakeholders know what they are doing, if they manage to secure interest from all the internal stakeholders, to get involved in those efforts, if they understand what their priorities are, what the ambition is. Because now we are no longer talking about voluntary action. Eventually, this is going to be mandatory, and this is what I would like it to be. It has to be there is the minimum ambition, I would say, would be voluntary. We want this to be eventually regulated. It should be mandatory.
So I think corporations have no idea what they want and no idea what they need. And every conversation I've had is like, I mean, I gave you a framework because I'm clearly have a team of people deep in this, but sitting with corporates on the other side of the table, they're a deer in headlights. I mean, they have no idea. So the best advice I could give somebody who's trying to come up the learning curve on some of this stuff is to think through and have an awareness of the challenges. So the leakage, the additionality, thinking through the lack of a standard and what your expectations are going into this. Expect a range of outcomes, right? Today, I think, given the inherent lack of transparency, it's really challenging to find credible carbon credits. And so keeping that in mind when you're making decisions, if I was going to go build a strategy, I would build one that is diversified by region, diversified by project type, and covers kind of short-term to long-term aspirations. So thinking through those three different pieces of the puzzle. When you think about building it, I would also, if you're familiar with the concept of a pacing analysis and private capital, which is basically in private capital, you're making commitments and then you're drawing commitments down and they're netting out over time. So you're trying to figure out at all times what your exposure is. Do the same thing with carbon credits is what kind of carbon credits are you buying? What are you retiring? Net them out so you understand your exposure over time and have a year-to-year tracking. Just parallel this with a traditional investment process, because I think in order for this to actually resonate, the foundation has to be placed in traditional capital markets, to your point. And so I think we have a strong need right now to match retirements with the emissions.
Okay. Well, in this space of this, I would like to mention just very briefly a very concrete initiative as well under the London Stock Exchange mandate, which is the first carbon credits fund in the space of biodiversity and natural capital, which is this fund from Foresight Sustainability Fund. It was launched in December last year, invested in reforestation in the UK. So this is a real initiative from an asset manager in the space of alternatives, giving very good returns, tackling the ambition of climate change. So I think this is a very, very concrete example. You have all the public information in the LSE, London Stock Exchange. Also, we can look at other initiatives like from Sotheby's, for instance. A couple of weeks ago, they launched a new big fund with carbon offset shares to help the decarbonization of their clients as well. So a very good initiative. So there are real business case now in the market, which is happening, no? But I would like to highlight as well that on the financial industry point of view, on the side of banks and some asset managers, there are some concerns because what we call the regulatory risk. Regulatory risk, I mean, by the risk of regulators changing their mind, okay? And we can connect with the first question of greenwashing, because what the regulator says today, maybe in 2 years' time is different. So, and this is what Jen, I agree with you. Sometimes corporates and big banks or big asset managers, they don't know what to do or what to do. And they prefer to be very prudent, to be fully compliant with the financial regulation. They have to do this. It's all about disclosure and so on. And they prefer to be very, very prudent. And on the other hand, in the space of capital markets, because capital markets are the real markets happening things in this context, this is where you come across with Schroders or Foresight Group raising concrete investment funds in the space of voluntary carbon markets, and funds that work and fully compliant.
So, Michelle, do you want to just quickly share your view on this before we move on to audience for the questions? Yeah.
Yeah, I think I agree with Jen in that when we speak with our customers, they are looking for us to tell them what good looks like, and it's a moving, it's a sand pit. Nobody really knows, will the definition of net zero change? When can you start using permanent carbon removal to get there? But I don't think, at least in our experience, asking the customer, what do you want to do? What do you care about? Doesn't work because they don't know, and that's why they're paying us to help them figure out what good looks like. I guess, like, transitions aside, what we tell our customers is set it. And at the end of the day, the carbon markets are a financial instrument to put money towards climate action, right? We've arrived at this tonnage like compensation framework that makes sense for buyers because you want to take care of your responsibility, clean up your trash. That doesn't have to be how it is, but that's what the norms that people have understood. And we tell our clients, start with as much carbon removal as you can afford for as much of your footprint as you can afford, whether that's a certain section that makes sense to you, you're hard to abate, business travel, or whatever it might be. And just start somewhere. Don't let perfect be the enemy of good, because if we all wait for the perfect system to arrive, we'll be dead, you know? So we need to just start with something, start acting. Even if it's imperfect, you'll make mistakes, be okay with that, and be transparent about the fact that you don't know. Nobody really knows what the right answer is, but you're trying and learning and getting better and being open about it.
Yeah, I think I would close with this one challenge is we need to think about how credits shift from a speculative tool to become the net zero management tool that they were intended to be in the first place.
That's
So
original intention, actually.
that was
in
the
start,
intention, and
yeah.
we're pretty far
It's
from the
been
intention.
completely derailed. Any questions from audience before we end this panel? There are like 4 questions.
Hi there, James Doherty from Plastic Eye. Brilliant panel, thank you very much. Would anything you say that you've discussed today be any different if we're considering blue carbon credits rather than kind of land-based? Or is that just even further back in kind of maturity levels?
You know, I got that same question at the last conference I was at. So that's funny. From my perspective, which is limited, you guys probably have more deeper on this than I am. I see blue carbon in the very nascent stages of development. So from an investment perspective, it's not topical in the conversations I'm having, but that doesn't mean that it's not important, not upcoming.
So I'm gonna take that if I may. So blue carbon, yes, blue carbon is very new as a concept, but is not new as a project. So we have coastal restoration projects, investment in mangroves, and that's still important. And the reason why, and there is a lot of emphasis right now, is because those type of projects offer not only mitigation but also adaptation benefits. So when we work on those projects, we also need to look at both angles. I think we are also living behind that area and focusing only on, for example, renewable energy projects, because right now all countries are setting up targets that those projects in the near future might no longer be additional in certain countries. In others, there is still need for the development of renewable energy projects and energy efficiency. But blue carbon projects, the benefits that they could give to the communities surrounding those areas are massive. The methodologies are still are already there, but they are constantly changing. And updating it, depending also on the local context, depending on the local government. Governments are also developing their own methodologies to develop those projects because there is interest about it.
So we can take one last question before we end this panel.
While we're searching for that, I'm going to ask you guys a question. If you raise your hands, I'm really curious. How many of you think that carbon removals are simply philanthropic investing, which means you cannot make money on carbon removals? Carbon removal projects like direct air capture, the blue carbon we're talking about. Can you make money on that? Do you think you can?
What do you mean?
Can they become profitable?
Yeah, if the price of carbon is more than it costs to produce.
I'm asking because so many people think that these projects are simply philanthropic and they're a cost center. So I think it's I'm raising it because I think it's an interesting point that they can actually generate money and be part of your story from that perspective. Yep, that's exactly. It's predicated on the cost of carbon. Who's the next question?
We've got one last question from a gentleman at the front.
Thank you very much. Hopefully it's a short question. Thank you to the panelists for such a great, insightful discussion. So I was just wondering, you mentioned about a lack of mandates and regulations around offsetting strategies and carbon credits. So do you foresee that being aligned with like other reporting disclosures, for example, like CDP or like now with SBTI, they only mention that you have to offset 10% of the residual emissions, but they don't tell you how or which specific methods to do it by. Do you think that's going to be a thing with, other reporting disclosures? And with that, there's probably going to be metrics. What are the challenges around that, do you think?
Do you want to take it?
Yeah, I mean, I think that guidance is V1, and they're going to have to update it, get it more sophisticated, more prescriptive and detailed. What is permanent? Is that 800 years? Is it 1,000 years? Is it there's no one's described that, and I think that we just should see that as a starting point, and it will have to become, clear and more obvious to comply with, and I think it will be regulated, absolutely.
I wanted to say that the International Sustainability Standard Board, ISSB, is doing a great work in that space, just responding to your question. However, we need clear guidelines in terms of the financial accounting rules about how to reflect in the financial statements, the income statement and balance sheet of companies and banks when they are trading with carbon credits. That's something pending, okay? But this is a homework of the International Accounting Standard Board, the IASB.
Just briefly, I think we are getting there. I don't know if you remember, but a few months ago, the European Union started with the carbon removal certification scheme. They are also looking at what could be considered permanent, which type of solutions will be considered removals, and that the attempt is to be a regulatory scheme. That is on one side, but we also need to understand what the scope and what is the mandate of a government agency. It might not be regulating what permanence is, or it might not be regulating what type of solutions are eligible, but maybe they are regulating what type of claims can you make, and then it would be up to the companies to decide whether or not those type of projects enable them to make those claims. I think we need to also to be conscious about that. What is the local context in that government, what type of mandate, the type of regulations that are in place, and governments can regulate up to a point.
Ladies and gentlemen, I think that's it for this panel. I'd like to particularly thank Kalyani for moderating. Fantastic panel. You couldn't have been better. Ladies and gentlemen, could you give a round of applause for our panel? Thank you.